Good afternoon, everyone. It is wonderful to be here. I am a long-time observer of everything happening in Saudi, but a first-time visitor. And you really can only experience the excitement when you're here in person. So just a bit about STR. If you haven't heard of us before, we collect hotel data all around the world. About 80,000 hotels working with us, and here in Saudi we have about half of all the rooms participating, sharing their hotel performance data with us so that they can benchmark each other's performance and improve, but also so that I can share insights with you to help those investing in hotels make better decisions. I had to pick this picture. I really enjoyed watching the Paris-Dakar rally not happen in Paris or Dakar at all, but happen in Saudi Arabia this year. Fantastic to see the landscapes coming through. The agenda, sort of the theme I thought I'd follow today would be to start with a global performance racetrack, see how around the world things are recovering as we come out of COVID, then move on to the kingdom and really focus on how performance is rallying here in the environment that we are in now and in the coming months. And then really, most importantly, finish off with the long-term future, where things are heading in terms of pipeline and performance. So starting with that global picture, you can see here occupancies around the world in some of the major continental countries indexed to 2019 levels. From the beginning of January to where we are now, middle of May. And three things to point out here. The first is, importantly, right at the top there, over 90% recovered. You can see the Middle East and the United States really leading the pack in terms of getting back to those 2019 levels of occupancy. Second thing is you can see China and Asia Pacific struggling. China particularly was fully recovered at one stage, but now with the zero COVID policy is back down to about 50% recovered, so it's showing just how fragile things can be. The third thing is something you won't see on here, and that is, if you look at the Europe line, there is no impact there at all from the impact of the war in Ukraine. Even though it's having a lot of uncertainty and geopolitical unrest, it is not unhinging the recovery in occupancies that we're seeing in Europe. And you also don't see anything in here in terms of inflation stopping those lines continuing to go up. So just reflecting on something that Pat said there, certainly for the next 12 months, what we expect to see globally is all this pent-up demand still coming through, and that should shelter the industry from any of the medium to long-term economic headwinds we're seeing for the next 12 months or so. But I'll go back to the first thing there and just that Middle East number, because you might ask yourself, certainly if you weren't from the region, well, why did the Middle East drop down like that in the last month? And it is, of course, Ramadan, and it is, of course, the timing of Ramadan being quite different in April this year, but it being in May in 2019. The good news is with an Excel file, you can do pretty much anything these days, and you can change the comparable. And so if we focus on the Middle East and look at occupancies week by week compared to index to 2019 and adjust for the different timing of Ramadan, what you can see is something even more impressive. And that is, for the last 2 months or so, across the whole of the Middle East, occupancies have been trending higher than they were in the comparable period in 2019. And as we head out past Eid into the future, I think this is the trend that we will continue to see across the region, and particularly in the kingdom. And that's true here when you look at just the Q1 results and look at occupancy, again, indexed to 2019. You can see that yes, Dubai did have the World Economic Forum. Yes, there was a lot of international travel going back, but it was only at about 100% of 2019 occupancies, whereas here in Saudi, Jeddah, Medina, Riyadh, Daman, Al-Kabar, all achieving occupancies already ahead of 2019 levels. And that's underpinned by this pent-up recovery locally, domestically, but also people coming here to support all of the wider economic development. I'm sure any of you who's had to fly to the kingdom in recent days have been on a very, very full flight. That's certainly what I've been hearing. So Saudi doing incredibly strongly in that context. And more on that in a bit, but just going back up to a global picture and looking at average room rates. Really incredible. coming out of a downturn, we have never at STR, and we have data going back 35 years, have never ever seen room rates recover as strongly following a downturn as we've seen in the Middle East. You can see averaging about 30% room rate growth ever since November last year. And you compare that to the rest of the world, Europe, the US up about 9-10%, and China, again, struggling with the zero COVID policy, back down minus 25%. And the reason that's so important for our industry is inflation is definitely out there. It's definitely a thing, and it will be a thing for the coming years. But if you're achieving average room rate growths like that, that will undoubtedly support continued profitability growth. So doing a similar analysis where we take out do a better comparability in terms of EAD, you can see still a very strong picture there, averaging at around about 30% for the last 2 months. Now that has really been driven by Dubai. Unsurprisingly, being a first mover, opening up to international travel, international luxury travel, and then followed on by huge events like the Cricket World Cup 2020 and Expo 2020, which has seen rates in particular in Dubai go up 30% and above. In the Kingdom, a bit more of a mixed bag. Certainly some positive rate growth there in Riyadh, Medina, Jeddah, in the big cities, but Dammam and Makkah still a bit behind as we got to the end of the first quarter. So let's just dig into those a bit more, and sort of 3 key stories that I wanted to pull out in the short term. Again, looking at the whole of the Kingdom and looking at occupancies indexed to 2019, adjusted for Ramadan, you can see, similar to the Middle East, for the last 2 months, we've been trending at above 2019 levels of occupancy. And Riyadh has really been a strong performer underpinning that, with averaging double-digit occupancy ahead of 2019 levels consistently this year. So really that economic activity demand coming back strongest first, and incredibly resilient here. When it comes to religious tourism, it's been 2 halves. If you look at Makkah and Medina, the good news is occupancies were back at or ahead of 2019 levels across the key Ramadan period. But from a rate perspective, that'll come in a bit. Where is it? I'll come onto rate for a bit. Looking at rate for Saudi as a whole, again, a positive picture where right up until Ramadan we saw some very, very strong rates, particularly in Jeddah. You'll see in a bit, underpinned by the Formula One Grand Prix there. Now in Ramadan, and then particularly in Eid, in the last 3 weeks there, it has been a bit weaker. It's typically a weaker period for rates in the Kingdom. A lot of people tend to leave and go to other markets. And I think this year it has been no exception. But I do expect that to bounce back as we head into a more normal period. So just on some of those, a bit more detail, we saw huge growth in average room rates in Jeddah in March this year. The second time the Grand Prix was held there, you can see rates going up to 250 times what they would usually be, 250% of what they'd usually be, and consistent with what it was when it happened in December last year, a similar sort of spike. So just showing the power of these events as they're organized and how they will drive rates and profitability across hotels in the region. This was the slide I was looking for earlier, and it's showing average rates in Mecca and Medina. And you can see that whilst in Medina, average rates this Ramadan have been much higher. In Mecca, a lot of new supply came in just before the pandemic, and I think the uncertainty around the timing of the recovery meant that hotels kept rates relatively competitive, and so they didn't quite recover to the typical levels you would see in Ramadan this year. But I'd expect that to recover going into the future. So what about profitability? So looking at March 2019, Saudi Arabia was there just a bit behind Qatar, with just over $50 gross operating profit per available room and about a 35% profit margin. And the amazing news is here we are in 2022, and because of that recovery at occupancy and at rate, across the whole of Saudi Arabia for where we were in March, we've seen that more than recover. We've seen profit per available room go up to $92, and a 44% margin ahead now of what's in Qatar. Not quite where Dubai is, underpinned by that really spectacular event-driven demand, but certainly the right direction to be moving in if you're investing in hotels. So that was all where we are now, what's happened, but clearly where we are now in the past is going to be very different as we look into the future to 2030, with the huge investment that's underway in the broader economy, but also particularly in our sector. And when you look at pipeline, so number of rooms that are planned to be developed, Saudi Arabia is a relatively small country relative to the likes of the United States and China, but on the global leaderboard of rooms in pipeline, the Saudi is there in fifth place. Now, this is with the projects that we have captured that are sufficiently verified to be in our pipeline, and that equates to about 80,000 rooms in Saudi. Now, we know that the actual number by the time we get to 2030 is going to be much, much larger. Depending on which estimates you look at, it could be anywhere from 300,000 to 500,000 rooms. So in reality, that the green flag there for Saudi Arabia could be all the way up to where United States and China is. But it's not there currently because a lot of these projects are still in their infancy, still in the process of being planned out and developed. But nonetheless, if you look at the region, the kingdom has 80,000 rooms, which is almost double the pipeline that we have in the UAE at the moment. And when you look at individual cities, that is when you can really see the scale of the development from a global perspective, with Mecca right up there in pole position in terms of the biggest pipeline of any city in the world. Now, if I was presenting in Europe or the US or anywhere else that was an established market, if you showed those kind of pipeline figures, that kind of new supply coming in, and especially when you put it in context of the existing hotel rooms in these markets, it would cause a lot of operators, a lot of existing investors to feel quite nervous. Because hotels, whether we like it or not, do tend to operate in a pretty perfect economic model that is where pricing is defined by the demand and supply balance. So if supply goes up a lot, but the demand doesn't follow, then there's a lot of pressure on hotels to reduce rates to capture demand, and there's a lot of competition. In contrast, if demand goes up a lot, but supply stays constant, hotels realize they have a pricing opportunity, they push up rates, and you see much higher profitability, Jeddah and the Grand Prix being a good example. So in most places, if you presented this, a lot of people would be concerned about what that would mean to future hotel performance. But I think what we will see for the next 2 to 3 years is that it won't be a major issue. And the reason it won't be a major issue is that when you look at the 80,000 rooms that we have in our pipeline, currently only about half, 35,000, are actually in construction. All the rest are planning, final planning. And if you take those 35,000 rooms and we look at every single project across every stage and we apply the typical levels of delays and attrition that we see for hotel projects in the Middle East, then it would show that the forecast number of rooms that we expect to open in the kingdom each year for the next 3 years would be about 6,000 rooms a year, which when you compare the last 10 years, which was about 4,000 rooms a year, is an increase. It's definitely an increase. And definitely when the supply came in 2016, 17, 18, that did impact hotel performance. But it is not an earth-shattering increase for the next 2 to 3 years. And when you take into account that the demand is forecast to grow so significantly, so these are our forecasts together with tourism economics. You've heard the figures, you know the figures. The target is 100 million visitors by 2030. We have it that overnight arrivals into the region will more than double by the time we get to 2030. And that increase will already be happening with us getting back to 2019 levels in 2022, which you can already see based on the numbers I presented, and then growing significantly 20-30% next year. And so these will only be realized if if things continue to open up, which they look to be doing. We haven't even yet really seen the impact of the new visa policy, which makes it so much easier to visit. There's 2 years of pent-up religious demand that's going to come through. And of course, there's all of the economic investment. So there's a lot of reasons why these demand numbers are there to be believed. But because the supply is actually growing relatively by a small amount in the next 2 to 3 years, that means that there should be an imbalance between demand and supply that will drive higher performance for the next 2-3 years until we start to see some of those mega projects start to come online. And so, in conclusion, I think it's fantastic to be here. It's a really, interesting time to be looking at this industry in the world. We're the last industry coming out of the impact of COVID. In theory, we should be impacted by inflation, by the war in Ukraine, but that's not going to be the case for the next 2 years. And when you look at this region in particular, the demand drivers are so strong that it should support a lot of the investment that is due to come, particularly if you look at what's opening up in the next 2 to 3 years. And that should put the industry in a good place for all those mega projects as they do materialize. And with that, I'd say thank you. Thank you, Gemma.
Thank you, Robin. Did you want to take any questions? Or?
Up to you.
Well, we probably have 2 minutes for questions. If we have one question from the audience, is there anything anyone would like to ask Robin this afternoon? Hands up. Robin, I'll ask you a question.
Sure, Gemma.
So you're talking there about the incredible pipeline and the demand. Will the pipeline be enough for demand way into the future? Where's it heading, post Vision 2030? What can we expect to see?
So do you mean, will the pipeline be large enough to accommodate that demand?
Where does it need to go next?
Well, I'd say, the target, if it's 500,000 rooms for 1 million tourists, that would be similar to what you see in France, as an example.
Right.
So that would be the right number. I would say the biggest risk is probably it takes too long for those rooms to materialize. It is everywhere in the world. It takes a long time to build hotels, and the Middle East is no exception. And when you look at what's in the pipeline and what looks set to come, it looks a bit behind where the demand forecasts are.
Right. But I guess if anyone can make it happen, it's Saudi Arabia, right?
Yeah.
Thank you, Robin.
Thank you.
Thank you very much. Thank you.